AMC joins us now. Harsha, what is your sense? Do you think the worst is behind markets? The worst may not be behind the economy, but is the worst behind the markets?
Good morning, Nikunj. At this point of time, it is really difficult to predict or rule out some more volatility in the market, simply because economy is going to take time to normalize even after the lifting of the lockdown. So at this point of time, I think it's better to look for companies which have lower fixed cost structures, lower leverage, and a balance sheet strength. I think across industries, we will have to look for these opportunities. And also there is a likelihood that the leader companies in each sector will consolidate their market position later on, as the ill effects of economic slowdown and the lockdown is going to be more on some of the smaller players in the industry.
So then what is your message to your unit holders? Because if you feel the volatility is here, economy is going to be in trouble, that why should one not redeem the units, or why should one not buy at lower levels?
Redeeming is an easy choice, right? I mean, if there is panic all around and you can just go and redeem. But in the past, in history, we have seen that such occasions really give you good opportunities for long-term investors. The systematic investment plan is designed to take care of that volatility. Just because you are investing every month, there is a possibility that you will invest at lower levels. There's a possibility that you will invest at higher levels. And current phase is one where you will be accumulating your units at lower valuations. Yes, the near term is hazy, but if you are unlikely to panic from the current volatility, you're likely to make more money because the valuations today are quite attractive. Even if you assume that a couple of months are going to go away in terms of lockdown and normalization thereafter, there is definitely going to be a significant valuation cushion at this point of time. But at the same time, the volatility may also persist. That's why I think a staggered and a disciplined approach is better rather than putting at lump sum investments.
What is your view on consumers? That's where one would imagine that the real disruption has not happened. Why? Because all of us are consuming essentials, which is food, hygiene products, soaps, shampoos. Consumer stocks, maybe consumer companies may be the least affected, but in terms of consumer stocks, do you think now it makes merit to stay with consumer stocks? Those who've criticized an HUL or a Godrej Consumer or a Britannia or a Marico, do you think they need to revisit their criticism? Because you need to buy safety and visibility, and consumer stocks right now are offering you some growth, unlike other sectors like banks or NBFCs or real estate or even IT, where we don't know what is in store for next 6, 8, 12 months.
I would tend to agree, although there is some bit of down trading that is happening in even FMCG, and also even the most resilient essential foods kind of a sector is witnessing some sort of a disruption because the packaging material is not available or the logistics are not the same as pre-lockdown period, etc. But I think even if you assume that there is going to be some impact, this is the sector which will be least impacted across the board. And also, the balance sheets are really strong in this sector as compared to many of the other leveraged sectors. So I would say that even though valuations may be a premium compared to history or compared to the market at this point of time, the FMCG sector definitely gives a lot of cushion on the downside. So I think investors who are there will continue to remain invested.
Harsha, morning. There's renewed interest in pharmaceutical names, and especially the new developments between India and US seem to be suggesting that just maybe pharma could be the next best avenue to invest in. Has one missed the boat when it comes to pharma? And if not, where within pharma do you find newer opportunities? Are you safer sticking by with healthcare, or is it pure play pharma generics that you need to be in?
We do have some stock-specific exposures in the pharma sector. We do have exposure to, apart from pharmaceutical companies, to the diagnostic lab space as well, which is likely to see a significant growth momentum going forward, given that some of the private labs are going to test COVID patients or suspected patients. So we have positions in some of the pharmaceutical manufacturers as well as these companies in the diagnostic space, and we'll continue to maintain that position. But to take a larger view on the sector is still difficult because there are issues which are business related, regulation related, which are unlikely to go away just because it's a defensive sector. Yes, to an extent, you could hide in that sector. But again, you'll have to remember that there are stock-specific issues, and those you have to avoid.
Sure. Talking about sectors to avoid, Harsha, and that's exactly what I wanted to ponder in a little deeper. In the recovery, and whenever the market do see a straight line recovery, or whichever way they choose to recover, what are the sectors that you need to avoid right now? What are the sectors you think will continue to grapple with the post-COVID hit and will be unable to really recover very, very, very quickly out of this entire economic slump?
Our belief is discretionary consumption will take a backseat for quite a while, even after the lockdown is lifted. So to that extent, I think some of the high-ticket purchases will remain affected. People will not have the confidence to really go and consume some of the discretionary items. So that's something that you can avoid at this point of time. And also, as I said in the beginning, it's more about the balance sheet strength and the cash flow strength. So the companies which are leveraged today, even in the least affected sectors, could have problems. So the companies which have higher fixed cost structures, if the lockdown continues for a longer period, will again have issues. So I think rather than taking a sectoral view, it's better to focus on individual companies which have steady cash flows, low leverage, low fixed cost, and look at then the business momentum that can change post the lockdown, and then accordingly place the bets.
Harsha, while of course financials remain a large part of your portfolio, and they continue to be a segment that is looked to drive things forward, is there any risk at all that you see, given that if we do see an extension of the lockdown, there's always a risk of companies that will be forced to, of course, shut or be in dire positions, default on loans? Is there a threat that you see on that front?
Yes, that risk is always there. The financials of the leveraged businesses, and also if the current economic disruption continues, there could be segments which were earlier not affected so much because of the economic slowdown, which would also start getting impacted adversely. For example, what would happen in terms of the retail loan book or the MSME loan book is still unknown. There are some stress points that are building up in these two segments. And if there is a longer lockdown, there could be issues in terms of that loan book as well. So again, within financials, one will have to look at the capital adequacy, the expectations on the asset quality front, and forget about credit growth at this point of time. I think as long as the balance sheets are fine in terms of capital and the underwriting standards are good, then you have to remain with those banks. And also there is a clear shift that is happening in terms of the liability franchise, and that's moving towards top few names in the banking industry. So those are the names which will be coming out stronger from this crisis rather than the entire financial sector.
Okay. All right. What about anything else that you're spotting, given that this is a very unusual, period that we're going through? Names that you feel would perhaps come out stronger? We've seen recently, different calls coming in selectively on some of the power companies or gas companies, for example. Anything along those lines, or something else that you've spotted in the market?
See, utilities are least disrupted during this period. But at the same time, you also need to look at some of the longer term issues in the sector. For example, we believe that gas is going to be preferred over thermal power utilities in the long term. So to that extent, our portfolio is tilted towards gas utilities rather than thermal power utilities. And we will continue to have that focus. Although in the short term, along with gas utilities, even thermal utilities could remain less affected in the stock market volatility. But I think from a longer term equation, it's better to remain in gas utilities.
It is pharma, pharma, pharma all the way. Aurobindo Pharma from 330, 340 has become 450. Sun Pharma from sub 300 has become 400 plus. Cipla is just moving from strength to strength. So pharma is the new buzzword, and frankly, a lot of Indian companies have got nothing to do with what currently hydrochloroquine production is there. I think in general, pharma is a space where you know that, with the exception of Glenmark, none of the pharma companies have debt. It's a completely under-owned sector. FIs don't have large exposure to pharma. Dollar is a huge interplay, and selectively I personally feel, and again there's no evidence of that, I've always seen that with a new change in trend, the leadership of the market always changes. US generic, FDA laws, spend on healthcare, these are factors which are going to be the new normal now. The new normal world, frankly, it does not matter what kind of AI system you have, or what kind of search engine do you have, or what kind of startup solution you are giving. This is a time where I expect that exceptionally strong amount of money would be spent on environment, healthcare, and other basic social related issues. That's my view, and that explains why pharma currently is just rising, and it is really moving higher. Harsha, Aisha asked you a question on pharma, but I want to revisit pharma. And what is the bull case scenario, Harsha, for pharma? Because let's assume that Ipcas and the Cadilas of the world, they get a bumper because of the virus, war, and because they made, hydroxyl chlorine. But that's an event. Let's take that event away. What is your understanding of the way the generic pricing is going to move? And do you think a reboot could happen in the US healthcare system because of this crisis?
See, as you mentioned, there are a couple of companies, if some of those molecules are used, they may gain in this COVID phase. But beyond that, I think the pressure on medical costs will remain across the globe. The entire focus of the government going forward will be to give better healthcare. So to that extent, the prices are unlikely to really see a spike. It remains to be seen whether some of the generic companies from India which are supplying to US will have less stringent FDA regulations simply because they would need more competition. That remains to be seen. But at least until now, we have not seen any indication where they have been more lenient on Indian manufacturers as compared to what they were in the past. So it's still too early to say that across the board, all US generic players from India will benefit from the current crisis, etc. So as I said earlier, we would still remain focused on a few of the stocks where some of the regulatory issues are less, or the balance sheet is not questionable. So some of those focus areas will remain for us.
Okay, Harsha, good to have you on the show. Thank you so much for taking the time out, and we'll see you